Hello, good evening, everyone. Chapter number 9th, Divisional Transfer Pricing. This is session number 2nd for chapter number 9th. Divisional Transfer Pricing. Let's revise what we have done in previous sessions. We have discussed about minimum and maximum transfer price, and that was covered under the negotiation or a bargain transfer price method. There were 3 transfer pricing methods. Number 1, cost-based transfer price method. Number 2, market price-based method. Number 3 was negotiation-based transfer price method. So we were dealing with method number 3, that was negotiation bargain method, and there we were doing minimum and maximum transfer price. Minimum transfer price, this transfer price is always calculated from the viewpoint of transferring division. And how do we calculate the minimum transfer price? To calculate the minimum transfer price, we have to relate with the relevant costing concepts. So here the minimum transfer price will be equals to, number 1, variable cost will be considered. Variable cost, up to where it will be considered? It will be considered up to the point of internal transfer. That means if any variable cost which has been incurred on that intermediate product or the goods which has been transferred by the receiving department, then that variable cost will not be considered. Only the variable cost which has been incurred up to the point of internal transfer, that will be considered. Number 2, we need to consider the opportunity cost. What is the opportunity cost? Contribution foregone by the transferring division on its external sales. Please mind it. We have to sacrifice external sales in order to do the internal transfer, right? And why we need to sacrifice? Because there will be a scare capacity, that means limited resources, and in that case we need to sacrifice our external sales, external demand, and in that case our contribution foregone will become an opportunity cost, right? Okay. The third thing, if any specific cost in the terms of variable or fixed will be considered as a relevant. That means even if a specific fixed cost has been incurred here, that will be only considered, not any kind. If we have already incurred a fixed cost, that will not be considered in a minimum transfer price calculation. Okay. And number 2, maximum transfer price. Maximum transfer price, it is always calculated from the viewpoint of receiving division. How do we calculate the maximum transfer price? The maximum transfer price is calculated as least of the following. Number 1, we have to consider the market price. Market price, that means whether it should be the selling price of what receiving division is selling its finished goods. No, it is not the selling price of the finished goods which receiving division is selling. It is also not the selling price which transferring division is selling in the external market. So what is this market price? This market price is the price at which the receiving division can procure that material or that component from an outside supplier. Okay, fine. So that means outside supplier, if anyone can procure direct from outside supplier, that will be considered as a market price for that product. Number 2, net effective cost, purchase cost. For example, we have received goods from internal division and we need to do some modification, and also we have incurred transportation cost. So we have to consider all that cost. That will be called as a net effective cost. Number 3, ability to pay. I have given you 2 situations, 2 examples, that through that we have understood what is the ability to pay. And ability to pay is really a concept which work on a basis of the logics. There is no concept regarding ability to pay, but it is only the concepts, it is the logics, how we think, how it should be. That is what ability to pay. Then we have discussed few questions. We have done 3 to 4 questions in our class because that was required, because we have to understand how the minimum transfer price is calculated, how the maximum transfer price is calculated, what happens when there is a limited or a constant of the resources, how our transfer price will be calculated. So in the previous session we have discussed this. Now today also we will be doing some more questions. These questions are will be known as a basic questions. I will be calling it as a basic questions. I am not dealing with the kind of the questions which will be asked in examination. That will be done from the session number 3rd, and it will be done in session number 4th. But today it's really important to understand how the calculation is done. This is really very, very important to first learn the basics, how the calculation is done. Then we will move towards the analysis, evaluation part, and how things will be connected with our examination. Okay. So let me see what we have done in previous session. Previous session we have done 3 questions. We have done 3 questions. Now it is the question number 4th. It is the question number 4th which we will be doing. Okay. So question number 4th. A company has 2 manufacturing division, Division A and B. Division A has a capacity of 96,000 hours per annum. It manufactures 2 products X and Y as per the following details. Okay. We have this details: direct material, variable cost at rupees 80 per hour, 320 and 80 rupees. See, here also it has mentioned that it's per hour basis. So definitely we will considering that material is separate from this variable cost. So 320, that means 4 hours and 1 hour. Selling price has been given. Maximum sales 15,000, and this product has an unlimited demand, unlimited sales. But there we have only 96,000 hours per annum. Division B produces product Z, whose particulars are as under: imported component, direct material, variable cost per at rupees 40 per hour, and a selling price. Okay, fine. Fixed overhead amounts to 30 lakh rupees. Okay, so let's do what we have how we were doing in previous session. That is from diagrammatic manner. That is question number A. A company has 2 divisions. Division A and Division B. A has a capacity of 96,000 hours. This is our capacity. 96,000 hours. It manufactures 2 products X and Y as per the following details. X and Y. See, first of all, we have to, this is really very important. Everyone, please understand that we have to calculate minimum and maximum transfer price in almost every cases. That means every question which you will be doing, you will be encountering minimum and maximum transfer price. So this is really very important to understand how the things has to be done. And there are a lot of informations which are interrelated to one division to another division. So this is why we are using this diagrammatic manner, so that you can understand the flow of information, how the data is related from one division to another division, so that we can clearly make a decision. X and Y, and we have selling price 800 and selling price 800 and 160. Direct material 360. Variable cost other than the direct material, it's 320 and 80. And maximum sales 15,000 units and unlimited. Okay, so we have done this table. Now division B produces product Z, whose particular are as under imported component and direct material. Okay, this produces product Z, whose selling price, let's find the selling price 1450. This is the selling price 1450, selling price, right? Less imported component 800 rupees, less imported component 800 rupees, less material, we have a material of 120 rupees, direct material, and then we have variable cost of 400 rupees, less variable cost of 400 rupees. Okay, fine. Fixed overheads amounts to rupees 30 lakh and 5 lakh rupees per annum for division A and B respectively. So what we can do, fixed overhead 30 lakhs and fixed overhead 5 lakhs. Now it's saying that with the view to minimize the dependence on the imported component, the company explored the possibility of division B using the product X as a substitute of imported component. What they are saying, that this component can be used as a substitute to this imported component. This component, that is the component, with a view to minimize the dependence on an imported component, the company explored the possibility of division B using product X as a substitute, right? This is possible provided division B spends 2 machine hours, entailing an additional expenditure of rupees 80 per component. That is, transfer price plus 80 additional rupees will be incurred by division B. The product of Z in division B is 5,000 units per annum. This is 5,000 units production and demand. And B seeks a discount of rupees 80 so that the transfer price of product X can be set at rupees 720. What they want, this division is seeking, this division wants TP rupees 720, right? Okay. Now, why we are doing this question? You might be thinking that in a previous session we have done this type of question, so why we are doing this question again? The reason is requirement of question is completely different. See, in a previous question we have learned how to calculate minimum and maximum transfer price. Here we will be learning how to calculate division wise and overall company profitability statement on the basis of the following condition. That means here we have to calculate profitability statement. We need not to calculate minimum and maximum transfer price. Minimum maximum transfer price has been already given us, that what will be the minimum or maximum transfer price, and the transfer price here it has been mentioned. We need to only prepare a division wise and overall profitability statement. So see, I have told you that what is the objective of this learning. What is the objective of doing these questions? We need to learn three things. Number one, minimum and maximum transfer price. Number second is profitability statement. So we have already learned minimum and maximum transfer price, how it is calculated. Today we will be learning profitability statement and best strategy situation, right? So this is what we are going to do in this question. We will be calculating the contribution per unit, and this is 800 minus 300 minus 320. It's 180. 160 minus 60 minus 80, 20. And according to the imported component, 1450 minus 800 minus 120 minus 400, we have 130 as a profit. This is contribution. This is contribution. Okay. Now the first requirement, what it is saying, we need to prepare division wise, that is division A and division B, and overall profitability statement as well. So profitability statement, if division B import its requirement, division B imports so we have particulars, division A, division B, and overall, that is company as a whole. We have product X and product Y, right? And as per the availability of hours, we can see this Y have an unlimited demand. That means the hours will be a limiting factor. We have 4 hours here and 1 hour here. How we have calculated? Very simple. Very simple. That is 320 divided by 80, 4 hours. 80 divided by 80, 1 hour. So hours for contribution per hour, will be 180 divided by 4, 45, and this will be 20. So ranking, according to ranking, this is first and this one is second. Okay. And under X, we have external sales as well as external sales. We have internal as well as external. That is external sales and internal. Please allow me 1 minute. I need to log in your because there is a Bhargavi and Namita, I will be taking your queries. I will be definitely taking your queries. Earlier, I was not able to see your queries, but now definitely I will be taking up your queries. First, proceed with this question with this example. Then definitely I will be coming to your queries. What you are saying. So we have external and internal demands, right? Okay. So how we will be calculating? First, we need to calculate our external and internal. We have to calculate our external and internal demand. See, there is a query, sir. Why? Please explain why we calculate contribution per hour. Is it a requirement or in question? See, when we need to calculate contribution per hour, when it will be a limiting factor. That means that hours are a limiting factor. How I came to know it? See, we have a 96,000 hours, right? We have a 96,000 hours as a full capacity of division A. And X can be produced 15,000 units. X has a demand 15,000 units, and each unit require 4 hours. That means 60,000 hours are required for X. And Y has an unlimited demand. Product Y has an unlimited demand. That means any number of units can be made and sold in the market. So if we could have more number of hours, we would be producing more units. But of what product we will be producing, whether it is X or Y. In order to calculate, we have to first know whether the requirement of hours versus availability of hour. That is, here requirement is unlimited. If we see, requirement of hours is unlimited, and demand and availability of hours is just only 96,000 hours. In that case, this becomes a limiting factor, key factor. And we know that when there is a limiting factor, we have to calculate contribution per hour so that we can do the ranking. After doing ranking, we can distribute, we can do the priority that first those hours will be allocated to that product which has a higher ranking, that will be yielding us a higher contribution, because hours, those limiting hours will be should be allocated to that product which will yield us a maximum contribution, that is called as an optimum product mix, right? So here we are also doing same thing. Our contribution per unit is 180, and our number of hours, the number of hours is 4 hour and 1 hour. And it will be contribution per hour. That is 45 rupees per hour and 20 rupees per hour. Ranking, the ranking will be, first ranking will be given to this and the second ranking will be given to this. We have 96,000 hours and now we are going to allocate. That is required hours, 60,000 hours, required hours and allocated 60,000 hours and 36,000 hours as a balancing figure. Okay, this is 36,000 hours as a balancing figure. Now we need 5,000 units for division B. And this product X can be used as a replacement of imported component. That means in order to transfer 5,000 units, we will be requiring 4 hours. That is 20,000 hours will be required if we want to do the internal transfer. But we have only 96,000 hours, and according to the priority, first X will be given priority, then Y will be. And we cannot withdraw the hours from this product because it is yielding us higher contribution. So we need to withdraw hours from here. That is 20,000 hours will be withdrawn from here. Okay, fine. If in case we need to do the internal transfer, right? But here in the first situation, we are not doing the internal transfer. All the division B requirement is being imported. That is imported component. There is an imported component being used. So external sales, we have 15,000 units and 36,000 units. How we have calculated it from this? By using 60,000 hours, we can produce 15,000 units. And by using 36,000 hours, we can produce 36,000 units of product Y. So this is what we have written here. Demand and see, in this case, we do not have any kind of internal, only external, and internal is, there is no internal sales. You can mention here, internal sales, no. Only, yes, this is what, 36,000 units. 36,000 units. This is sales demanded units. Division B, 5,000 units. So the total number of units will be 56,000 units. Now, we have selling price. We have selling price 800, or we can directly write down the contribution. We can directly write down the contribution by referring the previous statement as. So the contribution per unit is 180 and 20 and 130. So 180, 20 and 130 multiplied by sales demand. When we will be multiplying it with the sales demand, total contribution, that is 15,000 units into 180, 27 lakh rupees. 27 lakh rupees and 36,000 multiplied by 20, it will be 7,20,000. 5,000 into 130, 5,000 into 130, it will be 6,50,000. Right. Okay. So this becomes plus. We can do it this total afterwards. This is called total contribution. And total, that is total contribution of division A, is 7,20,000 plus 27 lakhs, 40,70,000. This is what, 27 lakhs plus 7,20,000. This comes 34,20,000. 34,20,000 is the total contribution of division A, right? We need to less fixed overheads. Fixed overhead is given 30 lakh rupees, and here we have a 5 lakh rupees. So this becomes 35 lakh rupees, and the profit is 4,20,000, 1,50,000, and we need to do this total, that is 34,20,000 plus 6,50,000, 40,70,000, and this will be 5,70,000 as a total profit. Any doubt, any query regarding the first part? See, first part is very simple. All the imported requirements has been, all the requirement of division B has been fulfilled by importing of component. We have not done the internal transfer. Now, what is the requirement of question number second? This second part. Division B uses 5,000 units of a substitute material product X transferred from division A at a market price of rupees 800. See, this has been very clearly given in this question that we will be transferring 5,000 units at 800 rupees market price. Fine. Now we have, this was external. See, this was external. Now we will be having internal sales as well. Internal. And the selling price is same. Selling price is same. That is, if it's 800 rupees, then contribution will also be 180 rupees. Can anyone tell me what will be the cost here? What will be the cost to this? What will be the cost of product cost? That is material X cost. How much it will cost to this material X? I want your answer. You need to answer. If we are replacing it with material X and the material X has been transferred at a market price of 800 rupees, what will be the cost to division B for material X? Please answer. Everyone, please answer. See, when we have used the market price as a transfer, we have transferred at 800 rupees plus 80 rupees will be involved for the modification. That means 880. That means 880. Now our contribution will decline by 80 rupees. Our contribution will decline by 80 rupees and it will become 50. This will become 50. 130 minus 80 is equals to 50. Is there any doubt, any query regarding this point? What we have done, see, I have done in this manner, but I can also show you here. See, the impact to division A, Bhargavi 720. Radha, your answer is correct. Namita, your answer is not correct. So let me tell you. See, first of all, division A, there will be no impact. There will be no impact on a contribution per unit. There will be no impact on a contribution per unit. Why? Because the market price is 800 rupees. They are selling product X. They are selling product X in the external market at rupees 800 and they are transferring. They are transferring at 800 rupees to the internal division B at the same price. So there is no change of contribution per unit in the case of division A for the product X. But yes, when they have transferred at 800 rupees, this 80 rupees will be incurred by division B for the enhancement. See, it has been given. An additional expenditure of 80 rupees per component or modification of product X to fit into product Z. This will be required and it will be done. This expenditure will be done by division B So now when we have a market price as a transfer price, market price as transfer price, the total cost to division B will be 880 rupees, not 800, not 720. It will be 800 rupees. Please explain this part once again. See, I'm explaining this part. I'm explaining this part. Only what is required. See, what is required. If they are saying that they have this point says transferred from division A at a market price of 800 rupees. Division A has transferred at 800 rupees, and division B will incur 80 rupees in addition to what the price has been, at what price the division A has transferred to division B. So the price at which division A is transferring is 800 rupees. We need to incur 80 rupees as the modification cost. So it will increase my cost. It will increase my cost. And on division B, contribution will reduce by 80 rupees. Why? Because earlier we were also purchasing this imported component at 800 rupees from the outside market. But due to the transfer is being done at 800 rupees, we need to also incur 80 rupees for the modification to fit into our product. This is why our contribution has been reduced. Now we will be preparing a statement. We are going to prepare a statement, profitability statement. Profitability statement, this is part second. When TP is, when the transfer price is market price, particulars and division. See, it would be more better if I make other changes in this statement. In this statement, if I can show you how this statement is going to change, really this will help you a very lot. See, when there is an internal demand, we need to withdraw 20,000 hours, right or not? We need to withdraw this 20,000 hours in order to meet the internal demand. We will be requiring 20,000. Only we have 96,000 hours. Whatever we have to produce, only we can produce in this limited hours of 96,000 hours. Product X yield us more contribution, higher contribution, so we are not going to sacrifice our external demand for X product. Yes, product Y is not yielding us so much in comparison to product X, so we can compromise or we can sacrifice the hours or the number of units of sales or demand of product Y. So what we are going to do, we are sacrificing 20,000 hours. These 20,000 hours will be used to produce 5,000 units of X that will be to transfer to division B. That means now I'm changing this statement, right? So that you can understand it very well. Now it has been transfer at market price. That is 800 rupees. Okay. So it has now changed. It has now changed. Earlier it was no, but now it will be 5,000 units. It will be 5,000 units. I'm making a change. You need to just understand the impact, how it is impacting your profitability statement. Here it will be 20,000 units, isn't it? Yes. Your contribution, this contribution will get changed, and here we have a 180 contribution. We have 180 rupees contribution. So let me calculate. 5,000 into 180. This comes 9 lakh rupees. This comes 9 lakh rupees. Okay. And this will be changed. This will change 20,000 into 20 rupees. That is 4 lakh rupees. And if we now add 27 lakhs plus 9 lakhs plus it's 4 lakhs, this comes 40 lakhs. And we have 30 lakhs as a fixed cost. So it will be a 10 lakh rupees. This will be a 10 lakh rupees. Fine. Okay. Yes. I have made this mistake. Yes. It's my mistake. Thank you for making a correction here. It will be 16,000 units. This will be a 16,000. Okay. So let me correct here. It will be 16,000 into 20. 16,000 into 20. 3,20,000. Right. So this will be 3,20,000 and 27 lakhs plus 9 lakhs plus 3,20,000. This comes 3920. 3920 as total. 3920, and we have 9,20,000 as a profit in division A. And if we now move here, we need to just change this 130 figure with 50 rupees. And this figure will be 50 into 5,000. That is 2,50,000. And negative, this will be minus 2,50,000. This will be minus 2,50,000. Right. So overall basis, on a total basis, we have 9,20,000 minus 2,50,000, that is 6,70,000. In this case, in a second situation, we have 6,70,000. Right. So this way, this is what we have done. Any query regarding second part? Sir, for product to Y, hours withdrawn. Okay. This was fine. Yes, very good to see Radha, Namita, Koshni, Meena. Very good to see that you have solved it on a very fast manner. Okay. Now moving to the third part. What they are saying. Division B uses 5,000 units of substitute material X, product X, transferred from division A at transfer price of 720. Now, if the transfer price is 720 rupees, how it is going to impact? How it is going to impact? First, to the division A. First, to the division A, it is going to impact here. They are going to get 720 rupees for internal transfer and 800 rupees for external sales. Okay, so let me change it. In this case now, they are going to get 720 rupees, isn't it? If it is 720 rupees, their contribution will now change to 100 rupees. Got it? Got this point? Okay. First, division A is now completed. Now move to division B. Before moving to division B, let's decide what will be the net effective cost to division B. It will be 720 rupees plus 80, it will be 800 rupees. It will be 800 rupees. So where we have now reduced our contribution, now we have to increase it further by 80 rupees. It will be again 130 rupees. So in this statement, what we are going to do? Number one change will be here. It will be 100 rupees, right? Number one change. Number second change will be total contribution. Profitability you need to calculate. Number second change will be here. It will be again back to 130. So let me calculate now. 5,000 into 100, that is 5 lakh rupees. Here we have 5 lakh rupees. That means 27 plus 5, it's 32 plus 3,22,000. 3,20,000, that is 3520. Total will be 3520 and 5,20,000 is the total amount of profit. And here we have 1,50,000 as a profit. So 5 lakh and 1 lakh, 6 lakh and 6,70,000 in the it will be same. Yes, overall will be again 6,70,000 rupees. So I hope so this question has brought you some clarity about the profitability statement. How, see, the task with the transfer pricing is not about understanding the concept. Really, that is the task, to understand the concept. But the main task, which will create a lot of problem to students, will be how the change in the information will be impacting your answer and how the student is relating it. How the student is correlating it with all the figures. The pace at which you change the figures, this will determine your ability to solve this transfer pricing questions. So this is really very important to first depict the questions in a diagrammatic manner. Plot all the informations like this. Whatever the question says, just change the information and you will be solving it accurately. There will be no fear, there will be no problem, there will be not a single confusion in your transfer pricing. Yes, Bhargavi, the profit is same as in the second scenario. That is, overall profit is same. Now, everyone, please come to the question number 5th. We are moving towards the best strategy questions. Best strategy question for company. A company is organized on a decentralized line with the manufacturing divisions operating as a separate profit center, and you know the meaning of profit centers and decentralized lines. For division manager has the full authority to decide on the sales of the division output to outsiders or to other divisions. Division AB manufactures a single standardized product. Some output is sold externally and the remaining is transferred to division XY, where it is a sub-assembly in the manufacture of that division's product. The unit cost of division AB and division XY is as follows. It has been given the unit cost of division AB and division XY is as follows. दिया हुआ यहां पे आपको देखना. So division AB manufactures single standardized product. Some product is sold externally, remaining is transferred to division XY, where it is sub-assembled in the manufacturer. So we have two divisions of a company. Let's prepare diagrammatic flow. Question number 5. Company AB and XY. AB and XY. And the unit cost of division AB and XY is given as follows. Transfer from division AB to XY at rupees 42. Okay. So we have external and we have internal. This is external and internal. Material from AB. This is material from AB. It cost him 42 rupees. And this has been given. Transfer from division AB to XY. Now material, direct material, 6 rupees and 35 rupees. Direct material, 6 rupees and 35 rupees. This cost will be same for whether it is external or internal. Then we have direct labor at 3 rupees and 4.5 rupees. Direct labor as 3 rupees and 4.5 rupees. Then a direct expenses of 3 rupees. It's saying variable manufacturing overhead is 3 rupees and 18 rupees. Variable manufacturing overhead is 3 rupees and 18 rupees. Fixed manufacturing and overheads, we are currently not considering it because we have to calculate a contribution statement. So we need to calculate the contribution. This is the reason why we are not taking a fixed cost. Can you tell me whether we need to take a variable selling and packing expenses? The answer is yes. Variable selling and packing expenses will be considered 3 rupees and 2.5 rupees. 3 rupees and 2.5 rupees. Right. We have to consider, see, if it is not given in question, we will be considering that selling expenses will not be incurred on internal transfer. We have to first read further question. We have to first read further question. Okay, so let's see what it is saying. Variable selling and packing expenses, 3 rupees and 2.5 rupees for division XY. Right. So currently I'm writing only for clarity purpose that any cost is not being skipped. Division AB sold 40,000 units annually at a standard price of rupees 45 in the external market. Okay. It is saying it sells annually 40,000 units at a selling price of rupees 45 in an external market. Okay. Fine. In addition to the external sales, 10,000 units are transferred annually to division XY at an internal price of rupees 42 per unit. Okay. Fine. In addition, this is given annually figures, right? A standard figure. 10,000 units and it is transferred. See, through this cost, we can verify that it has been transferred at rupees 42. It's correct, completely correct. The variable selling and packing expenses are not incurred by the supplying division for the internal transfer of the product. Now, the question is also clarified very clearly that this cost will not be incurred in a case of internal transfer. Okay. Division XY incorporates the transferred goods into a more advanced product. The manager of division XY disagree with the basis used to set the transfer price. Both the manager has some disagreement. He argues that the transfer price should be made at a variable cost. Definitely, the receiving division should always want that the transfer price should be done at a very low cost so that its profitability should increase. Since he claims that his division is taking output that division AB should be unable to sell at a price of rupees 45. What the division XY is saying, he's saying that division AB can sell 40,000 in external market. That's fine at a 45 rupees. But additional units, 10,000 units can't be sold in the external market. So why they are charging us 42 rupees? They should charge us variable cost. He also submitted a report of the relationship between selling price and the demand to support his disagreement. What is that? The report of the customer demanded a various selling price for the division AB and for division XY is as follows. Division AB selling price has been given 30, 45 and 60 rupees. Selling price is given. Okay. What is the demand at 30 rupees? 60,000. What is the demand at 45 rupees? 40,000. And what is the demand at 60 rupees? 20,000. That means at a 45 rupees, they can only sell 40,000 rupees, 40,000 units. Yes, when they will reducing their selling price, they can increase their demand to 60,000. Division XY selling price per unit is 120 rupees. If it's 120 rupees, the demand will be 15,000. When it is 135, the demand will be 10,000. When the selling price is 150, the demand will be 5,000. The company has a sufficient capacity to meet the demand at a various selling price. Internal transfer demanded units will be decided by division XY. Please underline this point, very, very, very important. This point is really, really, really very important. Why? Because the internal transfer units, demanded units will be decided by which division? It will be decided by the receiving division. It is not the transferring division who is going to decide the number of units, how many number of units is to be transferred. It is the receiving division who will be deciding how many number of units will be transferred. Okay. Required. You need to calculate the divisional overall profitability, division comma. That means division wise as well as overall profitability. If division AB transferred demanded units to XY at a price of rupees 42. See, in the first part, it is very clear. They are not fighting. They have told that division AB is going to transfer the demanded units at rupees 42 rupees. Okay, fine. So how many number of, see, currently they have not told us how many number of units is being transferred. It will be decided by which division? It will be decided by division XY. Now you might be thinking that we have already taken here 10,000 units, so why we are not transferring 10,000 units? See, this is what, this is a standard figure. This is a annual standard figure. This is an annually at a standard price. What they do, right? They transfer 10,000 units internally. But now the situation is completely changed here. Now it is saying that internal transfer demanded units will be decided by division XY. And this is a situation, you have to refer. So what we have to do, first we need to analyze it from the point of view of division XY. What will be the operating level? That means here 3 level of operations. Either he can operate at 15,000 units, 10,000 units, or 5,000 units. At what level he is going to operate? How that will be decided? That will be decided by the contribution. From the contribution, if the contribution is higher at 5,000 units, we will be deciding this point. Or if the contribution is higher at this point, we will be deciding this point. So we need to calculate the contribution. What is the total contribution? Fine. First we are going to prepare a statement. This is the first part and a working note number 1. A statement of Meena, we will not treat the selling expenses for internal sales because the question is clearly saying that we need not to consider. And also if the situation, if the information has been given, we can assume that the internal selling, on the internal sales, there will be no selling effort, there will be no selling expenses required. So this is what the cost we can avoid. Now the statement of contribution of division XY when TP is equals to 42 rupees. That is demand 15,000 units, 10,000 units, and 5,000 units. Selling price per unit 120, 135 and 150. 120, 135 and 150. Less variable cost, total variable cost, it will be, see what will be the total variable cost here? It will be 42 rupees plus 35, 42 plus 35 plus 4.50 plus 18 rupees plus 2.50. That is 102 is the total. 102 is the total variable cost that we will be considering. 102 per unit. 102, 102, 102. Sir, why we are calculating this statement? Because we can clearly understand the contribution will be higher in a case of 15,000 units. see, the number of units is higher. The number of units is higher, 15,000. So the contribution will also be higher at this point. Remember that. Remember this. Selling price is not same. If the selling price would have been same, we need not to prepare this statement. The selling price is different. This is why we are preparing. The contribution per unit will be different, and when we will be multiplying it with the number of units, the total contribution will also be different for all the three levels. It is not that number of units will determine the higher level of contribution. Say in this manner, contribution per unit is 18, 33 rupees and 48 rupees. Number of units multiplied, so total contribution will be 15,000 into 18 rupees. It will be 2,70,000. 33 rupees into 10,000. It will be 3,30,000. And 48 into 5,000, it will be 2,40,000. So from this statement, you can see that number of unit is higher, 15,000, but its contribution is not higher. The contribution is higher at this point. So as division XY has the authority. Who has the authority? The internal transfer demanded units will be decided by division XY. So this division will decide that he will be operating at 10,000 units, not at 15,000, not at 5,000, and he will demand 10,000 units from division AB, and division AB will transfer that 10,000 units at a rupees of 42 rupees. So 10,000 units will be demanded by division XY, right? So now we can prepare a profitability statement. Profitability statement is now very simple. Profitability statement. When TP is rupees 42, is rupees 42. Particulars, division AB, division XY, and company as a whole. We have external as well as internal, and the number of units. Number of units is 40,000 units, 10,000 units, and 10,000 units. And we are directly writing the contribution per unit, right? Contribution per unit. It will be, can you tell me what is the contribution per unit in this case? 45 rupees minus 6 rupees minus 3 rupees minus 3 rupees minus 3 and minus 3. That is 27 rupees. And what will be here? 42 minus 6 minus 3 minus 3 minus 3. So it will be also 27 rupees. And the selling price is 135 rupees for division XY. So 135 minus 102 becomes 33. This part is really simple. This part is really simple. You can write it 33, 3,30,000 as a total contribution, and 27 rupees and 27 rupees per unit total contribution. And yes, we need to reduce our fixed overheads. Fixed overhead has been given. We are going to calculate it now. The question is saying 6 rupees per unit is the absorbed overhead of division AB. So 6 multiplied by 50,000. It will be 6 multiplied by 50,000. It is 3 lakh rupees is the fixed cost, fixed overhead for division AB. For division XY, we have 18 rupees and multiplied by 10,000 units. It will be 1,80,000 rupees. It will be 1,80,000 rupees. So total contribution less 3 lakh rupees as a fixed overhead and 1,80,000 rupees as a fixed overhead. We have total fixed overhead 4,80,000, and it will be 27 into 50,000 rupees, 13,50,000. 13,50,000 minus 3 lakh, it will be 10,50,000 rupees as a profit. As a profit, this will be 3,30,000 minus 1,80,000. 1,50,000. 1,50,000 is the profit here. So total profit comes 12 lakh rupees. Right. $27 into 5,000. 27 into 50,000. Yes, this is the correct figure. So this is the profitability statement under part first. Any doubt regarding the first part calculation, you are completely free to ask. Second part, let's see the second part, what they are saying. To calculate divisional and overall profitability if division AB transfers demanded units to XY at a variable cost. Okay. What is the variable cost? What is the variable cost? Variable cost is 6 rupees. Variable cost is 3 rupees. Variable cost is this 3 rupees. Variable cost is this 3 rupees. So 6 plus 3, 9. 9 plus 3, 12. 12 plus 3, 15 rupees. So it is now going to transfer at rupees 15, and this contribution will be nil. Here it will be 15 rupees. It will be 15 rupees. And this will be 102 minus 42 plus 15,000, 75 rupees. This will be 75. Okay, I have written here. It's 12 lakh rupees. There it's I have written it 12 lakh rupees. Bhargavi, it's 12 lakh rupees. It's 12 lakh. Let me write it in this manner. So there will be no confusion. 12 lakhs. Okay. So we can see here it is going to now impact our contribution as well. Contribution. So my question to you, whether we need to prepare this statement again, this is my question to you. If my variable cost has been changed 75 rupees, do I need to prepare this statement again? Please everyone answer. Those who are watching this lecture live, you need to answer, do I need to prepare a statement again for this point? Because my variable cost has been changed. Do I need to prepare this statement, this working note again, or I can use it? I can use it in calculation of second part. Please answer. Those who are watching this lecture live, please answer me whether we need to prepare this statement again, or we can refer this statement and decide that 10,000 unit is fine and we have to continue. Very good, Bhargavi. 60. This is the contribution, that is 135 minus 70. 60 is the contribution. Okay, let me tell you, we need to prepare this statement again. How? Why? Let's see here. Let's see the impact. 60, it's 75 rupees. 75, 75, and 75. Right. So this is going to be 45 rupees. This is going to be 60 rupees. And this is going to be 75 rupees. Now let's multiply 15,000 into 75 rupee, 45 rupees. That is 6,75,000 rupees. It will be 6 lakh rupees, and 75 into 5,000. 75 into 5,000. 3,75,000. Now see this magic. We have to now move at this point. This is what the magic. Now we are going to produce, we are now going to demand 15,000 units from division AB, and this division, the company has a sufficient capacity to meet the demand of various selling points. It has a sufficient capacity. So the conclusion is that we need to prepare this statement again. You see, understand the impact when there is a change in a contribution per unit, and also the unit number of units is different. That is, the volume is changing, and a contribution per unit is also changing. So definitely we need to prepare a statement separately to understand at what level we will be achieving higher contribution. So we are now deciding to demand 15,000 units. Here, I am going to just use this statement so that you can understand where we need to do just only changes. It will be transfer price will be equals to variable cost, that is rupees 15, right? So first of all, our contribution will be changed here. The contribution will be 0 because we are transferring at a variable cost. There is no contribution in an internal transfer. This number of units will also get changed. Number of units will also change. It will be 15,000 units. This will also be 15,000 units. And the contribution we have, now the contribution we have 6. How much contribution we have? 45 rupees. Right. The contribution is 45 rupees. So definitely a total contribution is also going to change. The total contribution we have calculated 6,75,000 rupees. 6,75,000 rupees. Okay. My question to everyone, we have changed our number of units, that is 40,000, 15,000, 15,000. What will be our fixed overheads? Will be there any change in a fixed overhead? Good, Shafana. Will there be a change in a fixed overheads? Our fixed overhead will get changed or it will remain same? Please everyone answer. Will our fixed overhead also change? Because our fixed, we are operating now at 15,000, that is total is 55,000. Will we have to consider this as 55,000 into 6, 15,000 into 18. Good, Shafana. Because fixed cost is not going to change. So sir, how we have calculated this 3 lakh rupees? How we have calculated this 3 lakh rupees? If this would have been first part and this would have been second part, should we have calculated our fixed overhead at 55,000 units? No, my dear friend. How I have concluded this point, please see, they are saying that this is annually. This is what annually? 40,000 units is annually sold externally and 10,000 internally. This is what their operation normal capacity level. So you know that your total fixed cost or total budgeted overhead cost is divided by the normal capacity which is being planned to use, being utilized. So we are planning to use at 50,000. So the recovery rate 6 and 18 rupees. 6 has been calculated 50,000 units and 18 has been calculated 10,000 units. Whatever now we change our number of units, whether we reduce from 10,000 to 5,000, our fixed overheads is not going to change. Please mind this point very, very clearly. No, it is not going to change. Those who have answered Radha, Sachin, Namita, no, it is not going to change. What if I reduce my operating level to 5,000? Will I say that my fixed overhead is now going to change? No. Even I have increased from 50,000 to 55,000 and from 10,000 to 15,000. No, it is not going to change because our normal absorption rate has been calculated. Normal capacity has been already given that this is my normal capacity, 40,000 and 10,000. This has been considered. So we need not to now change our fixed overhead. It will remain same. It will remain same. Good, Bhargavi. So 3 lakh and 1,80,000 will be fixed cost. It will be no change. No change. Okay. So this is going to be what will be now our profit. What will be our profit? We need to calculate. 27 into 40,000. 27 into 40,000. It will be 10,80,000 minus 3 lakh rupees. It will be 7,80,000. 7,80,000 rupees. Okay. And 6,75,000 minus 1,80,000. 6,75,000 minus 1,80,000. It will be 4,95,000. 4,95,000. So 780 plus 495. It's now 12.75 lakhs. In the similar manner, in the similar fashion, what it is saying, in the place of internal transfer, now they are not doing internal transfer. Division AB can sell 10,000 units of its production in a new external market without affecting its existing market at a price of rupees 32 per unit. And Division XY can purchase these units at a rate of rupees 31 in the open market. Calculate the company's profitability by following the above strategy. Very simple. What you can do, you can change. See, this statement is really going to help you a lot. This is really it is going to help you a lot in your examination, when you are doing the concept of transfer pricing. This will change all your efforts. Now, what they are saying, there is no internal transfer. There is no internal transfer. There is another external market. There is another external market where we can sell at rupees 32. So definitely when we are going to sell in external market, this cost will be revived now. This cost is going to be revived 3 rupees, and our contribution will be different, right? And they can directly purchase from the external market at rupees 31. So it is going to change my variable cost and a contribution. So this will be the impact. We need not to now prepare this statement. Yes, this external, there will be another external market, separate external market, where we will be selling 10,000 units. 10,000 units. We will be calculating what is the contribution per unit, what is the total contribution, and this profitability will change. Here, our contribution per unit will change, total contribution will change, and profit will also get changed. And accordingly, our overall profitability will also get changed. So this part I am giving you as your practice. You need to just only practice with the third part. This is very clear. Now we are having a short break of 10 minutes. After that break, we will continue some more questions on transfer pricing. Everyone come to the question number 7. AB Limited has two divisions, A and B, making products A and B respectively. Fine. 1 unit of A is an input for each unit of B. B has the production capacity of 45,000 units and a ready market for 45,000 units in both year 1 and year 2. Other informations are available. So what it's saying, let's draw on the papers. Question number 7. AB Limited A division, division B, it produces product A and product B respectively, and 1:1 is the input output ratio. That means 1 unit of input or component of division A, that is the product A, 1 unit of product A will be required to produce 1 unit of product B. It's saying B has the production capacity of 45,000 units. 45,000 units is the capacity of division B, and a ready market for 45,000 units in both year 1 and year 2. Okay, fine. So let's do in this manner. This is my capacity, right? 45,000 units capacity, and demand in year 1 is 45,000 units, and demand in year 2 is also 45,000 units. Capacity production units year 1 and year 2 of division A, it has the capacity of production 50,000 and 50,000 units in year 1 and year 2. Fine. Maximum demand is 25,000, 30,000. Let me write it here. 50,000 and 50,000 is the capacity, and the demand is 25,000 units in year 1 and 30,000 units demand is in year 2. So this represents the demand and demand. Okay, so there is an external demand, a special order to be units to be fully accepted or fully rejected. So we need to make some changes here. We need to make some changes here. We know that we have a 50,000 units demand, and this 50,000 units demand have an external and a special order. External market and a special order. 25,000 units and 30,000 units in year 1 units. A special demand 10,000 units fully accepted or fully rejected. Either we can accept full order or we need to reject. We cannot accept partly, that is we cannot accept for 3,000, 4,000, 5,000. We cannot accept partly order. We have to accept full, or either we need to reject it. It is 10,000 units and 15,000 units. Fixed cost per annum up to 30,000 units will be 4,30,000, 4,30,000 in year 1 and year 2. That means if our production fixed cost will be 4,30,000 rupees for 30,000 units, right? Beyond 30,000 units, fixed cost increases by 1 lakh for every additional 10,000 units each year. So we have the capacity of 50,000 units. So you can calculate your fixed cost as plus 1 lakh for every 10,000 units into 2 into 2. It will be, that is 10 lakh, it will be total 6,30,000 rupees fixed cost. Variable manufacturing cost is 35 rupees year 1 and year 2. Now we have variable manufacturing cost 35 rupees year 1, 35 rupees year 2. Whether it is a special order, this cost will be incurred for the special order as well. Variable selling cost only for external sales, 10 rupees and 10 rupees. Variable selling cost 10 rupees and 10 rupees. It is only for external sales. Only for external sales. Variable selling cost per unit for a special order and transfer to B, 5 rupees. 5 rupees and 5 rupees. Please note that they have also told you there is a transfer to division B. So transfer to division B. Transfer to division B. It is that this cost will also be incurred here. 35 rupees, 35 rupees, 5 and 5. Selling price, usual external market price 65 in year 1 and 65 in year 2. Selling price 65 and 65. 55 is special order and 55 year 1 and year 2. 55 rupees and 55 rupees. Fine. They are saying now B buys input A. What they are doing? Division B buys from input A from outside. It is not from division, from outside at a slightly incomplete stage at a rate of rupees 30 per unit and incurs a subcontracting charges of rupees 20 per unit to complete it to a stage to match the output of division A. In year 2, subcontracting charges will increase to 30 rupees per unit. So it's saying that this division B is purchasing input A from outside market, year 1, 30 rupees they will be purchasing and 20 rupees will be subcontracting charges in year 1, and in year 2 30 rupees. This is year 1 and this is year 2. So what will be our net effective cost? It will be 50 rupees in year 1 and 60 rupees in year 2 if they purchases from outside market. We have added the subcontracting charges. B is willing to pay A the price it incurs with 50 and 60 per unit in year 1 and year 2 respectively, provided A supplies B's full requirement. What is the requirement of division? What is the requirement of division B? Its capacity 45,000. So if division A is willing to transfer all 45,000 units, they will be paying 50 rupees and 60 rupees what they are paying externally. But its demand is limited to only, its capacity is limited to only 50,000 units. That means if it's doing the external sales, special order and transfer to B, it cannot do all. 45,000 if done internal transfer, it has only the option to do remaining units as external sales. It cannot go for special order because it has a condition that either full or zero. That is either full needs to be supplied, full order need to be supplied, or no order need or no order will be done. What if division A supplies lesser quantity? What if they supply lesser quantity for division B? Then the division B will be willing to pay A only 45 rupees and 55 rupees per unit in year 1 and year 2 respectively. Assume no inventory, no change in inventory level. In year 2, A may choose to avoid the variable selling overhead rupees 5 per unit to units on transfers to B or its special order by incurring a special fixed overhead of rupees 50 per annum. What they are saying? They are saying, see, this division B has option. What kind of option? Either supply full requirement, then they will be getting 50 rupees in year 1 and 60 rupees in year 2. That is, full requirement is 45,000 units. What if lesser quantity? Then they are willing to pay 45 rupees and 55 rupees. That is 5 rupees lesser. 45 and 55. And what they are saying about this? In year 2, A may choose to avoid variable selling overhead of rupees 5 per unit on transfer to B or a special order by incurring fixed overhead of rupees 50,000 per unit per annum instead. They are saying in year 2, let me first write here also 35 and 35, 5 and 5. Year 2 and year 2. They cannot avoid the variable selling overhead on external sales. External sales variable selling overhead, selling cost will be incurred, but they have an option to avoid the variable selling overhead cost in year 2 on a special order all transferred to B by incurring, if they incur fixed overhead 50,000 rupees. Okay. So a lot of things we have to discuss in this area. Number one, how to decide how many number of units will be transferred to division B? How many number of units to be transferred to division B? It will be completely based on the contribution statement. That is, our decision will be completely based on the contribution. Those market or those units which are giving us higher contribution shall be given first priority, first ranking, and the balance will be then done. Okay. What about this 5 rupees? What about this 5 rupees? First of all, we have to understand, we need to understand whether we need to incur, whether we should incur this 50,000 rupees cost or not, whether we can recover all 50,000 rupees cost or not. That is, let's say I have decided that I am going to avoid this variable selling cost in year 2. Let's incur 50,000 rupees. But what if the benefit by avoiding the variable selling cost is just only 30,000 rupees or 40,000 rupees in comparison to 50,000 rupees? That means we have to check what is the break-even point. What is the break-even point of this fixed overhead? 50,000 rupees is the cost we are going to incur. What is the benefit we are going to get? The benefit we are going to get is rupees 5. We can say 5 rupees is the benefit we are going to get. That means at least 10,000 units, at least 10,000 units should be either internally transferred or done the special order. That means in a year 2, we should at least transfer 10,000 units or 15,000 units as a special order. How we can do? We can check how many number of units we have as a capacity. We have a capacity in year 2 as a 50,000 units. Let's say for a simplicity purpose, external sales has a higher contribution and we have given the first priority to the external sales. If we do the external sales of 30,000 in year 2, still we are having a surplus of 20,000 units that can be utilized. It can be utilized either a special order 15,000 units or 5,000 plus 5,000 internal transfer, or complete 20,000 units internal transfer. That means in any case we can achieve this fixed overhead, or we will be achieving this 10,000 units benchmark, and our number of internal transfer units will be more than 10,000 units, or special order will be more than 10,000 units, and we are going to fully recover this 50,000 rupees cost. So it is a beneficial decision for us to incur 50,000 rupees cost and to avoid the variable selling cost in year 2. We need to now prepare a contribution statement. Contribution statement of division A in year 2. In year 2, we have particulars. We have external sales we have a special order and we have internal transfer. Under internal transfer, either full 45,000 units or less than 45,000 units. Demand, we have 30,000 units as a demand in external sales, 15,000 demand as an special order units, and here we have demand as 45,000 units. Selling price, the selling price is 65 rupees, 55 rupees, 60 rupees and 55 rupees. 65, 55, 60 rupees and 55 rupees. Less variable cost. Under variable cost, we have manufacturing cost as rupees 35. That will be incurred. Variable manufacturing cost 35 rupees, 35 rupees and 35 and 35. Now variable selling cost, you need to put a star mark so that you can understand this point. Here we will be incurring 10 rupees, but here you need to refer this star point. You need to refer this star point. That is, we are not going to incur the variable selling cost in these cases because we have incurred 50,000 rupees and avoided this cost. Okay. So it will be 20 rupees from the external demand, external sales, 30 rupees in case of a special order, 25 rupees. It is 20 rupees here. It is 20 rupees. Here we have 25 rupees and 20 rupees. So if we do the ranking, this will be the first rank. If we do 45,000 units, this is going to be not applicable. That is, it is either we can do one thing, either we can fully supply or lesser. So if we see that there is a higher contribution from supplying fuller capacity, so it will be 25 rupees. So it is not applicable. Here the ranking will be done, but we have only 5,000 units and it is not going to accept those 5,000 units. So this is also not possible, not applicable. The second ranking will be done to the external sales. Second ranking will be done to the external sales. Right. So going through this, we came to know that 45,000 units will be produced and done internal transfer. We will be doing internal transfer of 45,000 units, and 5,000 units will be done as an external sales. Yes, in a special order, we were having a 20 rupees as a contribution. So when we need to do the ranking, first ranking will be done here and a second ranking will be done here. We cannot do this. We cannot do this. So these are the units that will be done. So let's see what is the requirement. What will be the maximum profit of A under its best strategy in year second? So we need to write the best strategy of A. in year second. So the maximum profit, best strategy. Best strategy is what? Transfer 45,000 units to division B and balance 5,000 units as external sales. Second, incur 50,000 rupees as additional fixed cost to avoid variable selling cost in year second. So profitability, it will be contribution. Sir, why we cannot do the second ranking to the special order? Dear, either we can supply the full quantity, that is their demand is 15,000 units, or zero. If there is 14,999 units, still the special order can't be done. When we are supplying 45,000 units to the internal division, we are left only, we have a balancing 5,000 units that cannot meet our special order demand. So those 5,000 units will be diverted towards the external sales. Contribution from external sales, 5,000 units into 20 rupees, rupees 1 lakh. From internal, transfer 45,000 units into 25 rupees. So this is going to be 45 into 45,000 into 25. $11,25,000 less fixed overhead 6,30,000 plus there is a special fixed overhead which we have incurred. So it's 6,80,000 rupees, and our profit will be profitability under best strategy. It will be plus 1 lakhs plus minus 6,80,000, 5,45,000 is the profit amount which will be earned when we follow our best strategy. What is best strategy? Transfer 45,000 units to division B and 5,000 units external sales. This is what required in the first part. Any query, any doubt regarding the first part, you are completely free to ask. If you have any query regarding the first part, you can ask. It's saying that in the view of the company's overall interest, calculate the customer-wise units to be produced in year one. We need to prepare for this. See, we have calculated the number of units through this contribution statement. Through this contribution statement that we are going to again prepare for the second part. For the second part, it's saying that contribution statement for year 2. Yes, Bhargavi, the answer is 5,45,000. Particulars and we have external sales, or I can use this table. I can use this table. Just we need to change this figure. It's year 1. We have the selling price 65. We have the selling price as 65, 55, 50 and 45. 65 and also the demands. The demand here is 25,000, 10,000, 25,000 units, 10,000 units. In year 1, we have 65 and 55. 65, 55 and 50 rupees. That is 50 rupees. For lesser quantity, 45 rupees. This cost will be incurred 35 rupees. And yes, variable selling cost will be incurred. Now, we need to remove this star mark because in year 1, there was no option to avoid your variable selling cost. So we are going to incur 5 rupees for each, and variable cost contribution per unit is going to change. Contribution per unit is ₹20, 15 rupees, 10 rupees, and 5 rupees. And if we do the ranking will be first ranking to this, second ranking to this, and this can't be done. Will be not applicable because after doing this, we have done 25,000 units. We have done 25,000 units. We have done with the 10,000 units here. Now we are having a balance of only 15,000 units. So this condition doesn't apply, and we will be doing 15,000 units. So the answer is external sales 25,000 units and internal, that is special order, is 10,000 units, and transfer to division B will be 15,000 units. Total 50,000. Any query from the second point, second part? Third question, third part, assuming that A follows, its best strategy between what value of transfer price will B be able to negotiate with A so that the A's best strategy is unchanged in year second. What is the best strategy of A? A has to transfer 45,000 units to division. It has to transfer 45,000 units to division B. So that strategy will not change. According to that strategy in year second, you have to calculate what is the minimum and maximum transfer price. This is what? Following the best strategy, that is for first part, you have to calculate the minimum and maximum transfer price. Okay. So let me calculate here. Minimum transfer price. How we calculate the minimum transfer price? First, we need to calculate the variable cost. So in the year second, we have a variable cost of rupees 35 only. We have variable cost only 35 rupees. Do we have any kind of opportunity cost? Yes, we have an opportunity cost because we are sacrificing our external sales. So what is that external sales? See, we have sacrificed our external sales or a special order. In the both case, we could have earned 20 rupees. See, this was the situation when we were in year 2. This selling cost was not incurred and we were incurring 20, our contribution was 20 rupees. So either we choose external or special order, there will be a 20 rupees per unit contribution loss. That will be considered as a 20 rupees contribution loss per unit. And yes, there is a specific fixed cost. What is that specific fixed cost? A specific fixed cost, we have incurred 50,000 rupees. For how many number of units? For 45,000 units. For 45,000 units, we have incurred 50,000 rupees cost. So it will be 1.11 rupees. So it's coming here 35 plus 20, 55, and it will be 56.11 will be your minimum transfer price. What will be your maximum transfer price? Maximum transfer price is always calculated from the viewpoint of receiving division. So in year 2, he is paying to the outsider 30 rupees for the purchase cost plus 30 rupees for subcontracting charges, that is 60 rupees is the maximum transfer price, and the range for negotiation will be 56.11 to 60 rupees. This will be a range of negotiation. Anyone having query from first part, second part, or third part, you can ask. Any query? Any query, whatever we have done in a first, second, third part? Any query from your side? If it's clear, we are moving towards question number 10th. We are moving towards question number 10th. X Limited has two divisions, A and B, which manufactures product A and B respectively. Question number 10th. X Limited has two divisions, division A and division B. A and B. Information has been given. Division A, material cost 50 rupees. Direct material cost 50 rupees. ₹24 other than direct material B, other than direct material A. Then material A cost 144 if transferred from division A, and if purchased from outside it will be 160. Okay, fine. 144 slash 160. Hope you can understand this point. If it is purchased from outside, it will be 160. Otherwise, it will be 144. Direct labor 25 and 14. Direct labor 25 and 14. Variable production overhead is 20 rupees and 2 rupees. Variable selling overhead is 13 and 26. Selling price in the outside market 160 and 300 rupees. If it's external market, the selling price is 160. External market. If this is internal transfer, division B, external market, and selling price would be 144, and selling price to S Limited. There is some S Limited. Selling price is 250 rupees and 300 rupees. 300 rupees in this case and 250 rupees in this case. Here we have 144 rupees price. Now, this question is speaking other information, giving us other information. To make 1 unit of B, 1 unit of component A is needed. That is, input output ratio is 1:1. 1:1. Fine. And if transferred from A and A, B presently takes product A at rupees 144. With A not incurring variable selling overhead on units transferred to B. Fine. So 50 rupees, 25 rupees, 20 rupees. This 3 rupees cost will not be incurred. Product A is available in the outside market at rupees 160 per unit. We know this. B can sell its product B in the external market at rupees 300 per unit, whereas if it supplies to X Limited, subsidiary S Limited, it supplies at rupees 250 per unit and need not incur variable selling overhead on units transferred to S Limited. S Limited requires 6,000 units and stipulates a condition that either all 6,000 units will be taken from B or none at all. It's saying that either 6,000 units or 0. And we have a 24, 144, 160, 14, 2 and 26. This is variable selling overhead cost that will not be incurred in a case of S Limited. Now, we can calculate the contribution itself here. The contribution is 160. Can you help me out for calculating the contribution? See, 160 minus 25 minus 20 minus 13. $160 minus 50 minus 25 minus 20 minus 30. 52 rupees. This will be 144 minus 50 minus 25 minus 20. That is 49. And it will be 300 minus 24 minus 144 minus 14 minus 2. That is 116. Good, Shafana. External market share, let me calculate once again. 300 minus 24 minus 144 minus 14 minus 2 and minus 26. It's 90. It's 90. And if we further reduce 16 rupees, because this cost is more 16 rupees, it will be 74 rupees. And 250 rupees minus 24 minus 144 minus 14 minus 2 rupees, 66 and 15. So this is the contribution. It is our contribution. Once we have calculated the contribution, now let's see what is the requirement of this question. What is the question saying? Question is saying manufacturing capacity of A is 20,000 units. Okay, let's see. Its manufacturing capacity is 20,000 units. Fine. That is a limiting factor. External market demand. External demand is 18,000 units. Given manufacturing capacity of B is 28,000. External demand is 26,000. S limited 6,000 units or 0 units. Fine. Now how we will decide how many number of units will be internally transferred, or how many number of units we will be doing external sales. How we can decide that first we have to do external sales, then internal transfer, or first internal transfer, then external sales? Through its contribution per unit. So according to the ranking, first ranking is to the this external market, and this one is second one. Okay, right. So what we are going to do in this situation, 18,000 units will be external sales, and 2,000 units will be internal transfer. This will be the best strategy. What it is asking, assume that division A and B have to operate during the year. What is the best strategy for division or department A? So for best strategy, first part, best strategy for department or division A, external sales 18,000 units, internal transfer 2,000 units, and you will also prepare a profitability statement, profitability or contribution statement for division A or department A. Best strategy. You need to show under best strategy what is the profitability or contribution. So we have particulars and contribution from external sales, $18,000 units into 52 rupees. Second, internal transfer 2,000 units into 49. That is 2000 into 49. 98,000 and 18,000 into 52 rupees, 9,36,000 rupees. Do we have a fixed overhead or fixed cost in this question? Do we have any kind of fixed overhead or fixed overhead in this question? There is no fixed overhead or there is no fixed cost in this question. So it will be 10,34,000 will be our total contribution from best strategy. Yes, Shafna. This was the first part, best strategy for division A. Department B, given that A will use its best strategy. What is the best strategy for division A? To internal transfer 2000 units. So what, using this strategy of division A, what will be the department B's best strategy? Now we need to evaluate. If we see, the first ranking is to the external market and the second ranking is to the S Limited. So we have an option to first fulfill 26,000 units external market demand of division B, and there will be remaining 2,000 units that can be supplied to division S. But there is a condition from S Limited that they are not going to accept any quantity less than 6,000. Their demand is 6,000 units. If you cannot provide, they will not be accepting any lesser quantity. So first option is that you can do the external market, external sales, external market 26,000 units, or the second option can also be seen where 6,000 units can be sold to S Limited and balance 22,000 units should be to the external sales. Why we are doing so? Because there are 2,000 units on which there will be no contribution. So it's better to first also check whether if we can supply S Limited full capacity 6,000 units and then remaining 22,000 to external market. See, Namita, we need to show if we follow this strategy, if we follow this strategy, this will be the best strategy. See, we have taken the decision on the basis of the contribution per unit. In some cases, in some solutions, you will be finding that the best strategy has been decided by calculating its contribution under different options. What we do in the best strategy, we count how many alternatives we have, how many options we have, and in each options what is our outcome, what is our profitability, or what is our contribution. On that we will be deciding that this will be our best strategy. But we have taken a decision at a upper level. We have taken a decision at a upper level, at a marginal point basis. So there we have decided that this is our best strategy, and we need to show if we follow this best strategy, this will be our profitability. So this is the reason why we need to show our profitability or contribution. In department B, we have two options. Second part, Option number 1, option A, external sales 26,000 units and no sales to S Limited. Option number 2, 6,000 units sales to S Limited and 22,000 units sales to external sales or external market. So first we are going to see option number A. We need to calculate. Now we will be calculating what is the contribution if we follow our option A. See, contribution of division B, that is contribution on units internally transferred, 2,000 units which has been internally transferred under the best strategy of division A, it will be multiplied with 90 rupees. And on units purchased, that is material A units purchased from outside. Although this is our external sales from external market, this will be a number of units we have sold, 26,000 units, 24,000 units into 74 rupees. So 90 into 2,000, 1,80,000 and 17,76,000. Total will be 19,56,000. If we follow the option number 2, option 2 or option B, that is S Limited sales 6,000 units and external market 22,000 units. So what will be the contribution? Yes, Namita, the contribution answer is correct. 19,56,000. Yes, Shafna, answer is correct. Contribution. See, the contribution, total contribution statement we are preparing. Total contribution statement. First, contribution on external sales, that is 22,000 units. We have internally transferred 2,000 units, so we can consider either into the external sales or into the S limited sales. Anywhere we can consider, but only we have to take the effect of 2,000 units only. So it will be, this will be on material A transferred internally at a rate of rupees 144. So we have a contribution of 90 rupees into 2,000 units on material A purchased from outside. 74 into 20,000 units. And second, contribution on internal, on S limited 6,000 units on material A purchased from outside. That is 6,000 into, it will be 50 rupees. It will be 50 rupees. That is 3 lakh rupees. And here we have 1,80,000 and 74 into 20,000, 14,80,000 plus 4,80,000 plus 14,80,000. That is 19,60,000. Is your total contribution. Yes, good, Shafna. Now, can you decide which is the best option for division B? What is the best strategy for division B? Best strategy for division B. Either option number A or option number B. In option number A, our contribution is 19,56,000, and in option number second, our contribution is 19,60,000 rupees. So we will be choosing the option number second. Will be the best strategy. You have to mention what is the best strategy here. That's it. That's it. X limited as a whole, we will be discussing it later on. X limited as a whole, we will be discussing in the next class. Now, any query what we have done so far from in the session number 1 and session number 2, any student having any kind of a query, you can ask. This was the best strategy questions, profitability statement, and minimum and maximum price calculation. So basic calculation part we have covered up. Now in from session number 3rd and onwards, we will be covering up our those questions which are the latest ICAI is being asking in your examination. That means we have to analyze, we have to use in a theoretical manner. That is what into analysis manner, the evaluation manner that we will be using skills. Yes, the option is correct, option number B. And one student has asked me about, sir, if you don't mind, could you please explain how to analyze about the ability to pay? Bit confusing, sir. Bhargavi, please note here. I have given you example, option number C, ability to pay. Now see, ability to pay. I have given an example. For example, I am a division. I am a division B, right? My selling price, what is the selling price in this case? Let's consider the selling price is 300 rupees, right? The selling price is 300 rupees. What are the other costs like 24, 14 rupees, 2 rupees and 26 rupees? So let me add it. 24 rupees plus 14 rupees plus that is 24 plus 14 plus 2 rupees plus 26. 66 rupees is the additional processing cost. This is additional processing cost. That means this cost is I am going to incur in my department, right? Now it comes, what is the ability to pay? How much maximum I can pay for the internal unit, for the internal transfer unit? Here we have 144 rupees. Here we have 144 rupees. But maximum to maximum I can pay. Maximum, that means it is my maximum limit. It is not that I am paying. It doesn't mean that maximum availability to pay doesn't mean that the transfer price is this. This is what the maximum limit. If you talk beyond this point, it will be not beneficial for division B to consider your transfer price. So what will be, it will be 34 rupees is the ability to pay. Ability to pay here is 234 rupees. Maximum to maximum a division can think to pay 234 rupees. Beyond if you set your transfer price at 235 rupees, this division B will be saying, boss, leave it. Because if your transfer price is 235, for example, if your transfer price is 235, you will be incurring a loss of 1 rupees. So you will not be motivated to work. You will not be involved in internal transfer. It's better for you to purchase from outside. So definitely this is what your ability to pay. It is what called as the ability to pay. And in question number, I think 5th, in the question number 5th, Yes, Sergeant Bajaj, I will provide the solution for all the parts, all the questions what I have provided you. I will be providing you all 10 question solutions. So don't worry about this. So Bhargavi, is this your query clear now? What is the ability to pay? Is this query clear? And also one question we have done here. See, if the additional expenditure is 80 rupees, in that case, you can see they were procuring it imported component 800 rupees from the outside market. They were procuring from the outside market at 800 rupees. Right. Yes. In this case, for example, for division B, if it can purchase from outside 800 rupees, if it can purchase from outside directly from outside 800 rupees, and he know that division B, if I have to purchase from division A, I need to do some modification to use it into my product Z. So I need some modification. That modification cost will be 80 rupees. So the maximum willingness, the maximum amount I can be willing to pay, the ability to pay will be 720 rupees. If you charge 730 rupees or 800 rupees, it will not be viable for me. It will not be profitable for me. It would be more beneficial. It would be more in my interest to purchase from outside rather than from internal transfer. Bhargavi, here we need to set my ability to pay. Here it will be 720 rupees. Ability to pay. See, why I would be paying 800 rupees? Why I would be paying 800 rupees and then incurring 80 rupees? I can directly purchase that component from the outside market at 800 rupees and use it. Why I need to pay first 800 rupees, then incur further 80 rupees in a modification. That means my total cost for that component will be 880 rupees. So it is not wise decision. If I know that 80 rupees will be incurred, so that's fine. If I will be negotiating with my division A, I will be saying, if you are willing to pay, if you are willing to provide me that component at rupees 720, then I will be willing to purchase I will be willing to accept your internal transfer units. Bhargavi, is it clear? So thank you so much everyone for today's session. Good night, bye-bye. We will be meeting on Friday and doing a lot of more questions on transfer pricing. Definitely this chapter you will be more comfortable on the third and fourth sessions, after the third and fourth session. So thank you so much everyone. Yes.